Happy Thursday. So it looks like we've got some new names. So for anybody who's new, welcome. My name is Kendra Rhodes, and I will be hosting the Life Plan 360 training today. We're going to wait a couple minutes to get started just to get people on. Today is very much about class participation. So again, anybody who's been to my trainings before, please feel free to jump in. Any new people, please feel free to jump in. Peter, welcome back. Marcus, hi, how are you? Andrew, hi. So before we get started, I'm just admitting some people. And also, please feel free to use the chat. But if I am not, I'm not answering your question or comment in the chat, please feel free to unmute yourself and just say it, ask me, because I'm usually multitasking, doing multiple things at the same time, and the chat often gets ignored. So please feel free to jump in. So before we get started, as people are joining, does anybody have any questions about anything that we've talked about before? Anything before we get started? Okay. So we're going to wait just a minute to get started, to let a few more people jump on. So Peter, did you send me an email? I thought I responded to everybody's emails.
Yeah, but it was maybe the next day. It wasn't the same day. I may have sent the request Friday or maybe even Saturday.
That's odd. Let me just write down your email and I will send it after the training. What is your email, Peter?
Peter@jacksonfinancialsystems.com.
.com. Okay. I will send you what spreadsheet was it, the budgeting spreadsheet?
Yeah.
Okay. Budgeting. Okay.
All right, thank you.
I will send that to you.
Oh, Kendra, can you send it to me too, Sabrina?
Yep. Do I have your email address?
I want to say you do because you emailed me to get me onto these trainings.
You're right. I've got to have it somewhere. So send it to Sabrina.
Well, I'll give it to you. It's LBA Consulting Group.
Oh, I do have it. Yep, LBA.
Yeah, Consulting Group 2@gmail.com.
Hi, Sabrina.
Hi, Peter.
Long time no
Okay.
see.
Yep. So I've got a couple more people joining. Okay, so it is 5 past and we have a good group and we've got a lot to talk about today. I just wanted to let everybody in so that everybody has a chance to participate. So, and we will add more people as they join. So let me pull up, let me share my screen. Let's start there. Share screen, one share. Okay, so can everybody see out the 360 symbol in the middle?
Yes.
Yep. Great. Okay. So we are going to, just to start with, pull up a dummy client that I made a while ago. We'll do this. Okay. So we've been going through the software and building plans for people and going through all the features and seeing how everything works and what we can do, and really, Parkinson's laws and 11 reasons to carry a big long mortgage, and what does the creator of the 401k say about the 401k, and all that's great. But there's a couple things that we have not talked about. So what are we actually trying to do? What are we trying to accomplish? Very open-ended question. So anybody jump in. Anybody?
What was the question?
What are we trying to accomplish? What is our end goal?
Get them to build their own bank.
Thank you. Right off the bat, the exact answer I was looking for. So we're trying to get them to build their own bank so that they can divorce the commercial banks, right?
Right.
So that they are no longer beholden to the crappy interest rates in their savings account, the up and down of the market for their retirement. And when they need to purchase something like a car or a house, having a high interest rate that completely nullifies the interest rate that they are earning in their savings, right? This is what we're trying to do. Yes?
Yes.
Okay, great.
Yes.
So, sorry, let me just admit some people here. Perfect. So that being said, what do the banks do? How do we do that?
What was that question again?
What do the banks do? How do we get our clients to become their own bank? How do we do that?
We get them to, first of all, we got to find where the money is.
Right, we've done that. So if
Yeah.
we're looking at this client that sorry, 1 second, admitting people. If we look at this client, we've figured out where their money is, and we've put together a plan, and we figured out that this client annually has $111,000 and $27,000 to start their bank with. Their big pile of money is $27,000, and they have $111,000 annually that they can be contributing to their bank outside of their lifestyle, right? So we've figured out where the money is. How do we get them to be a bank?
Now we run the illustration. We run the Forester, or
Okay, so
We'll build a policy for them.
why are we building a policy for them?
because that's where we build the bank.
Okay,
Money.
why?
So do we build a policy to overfund that policy?
Okay, I like where you guys are going with this, but let's think about it from a client perspective. So there's something that I'd like to bring up that many of you have seen before. Is anybody familiar with the FDIC?
Oh,
Yes.
because of the bank are using life insurance. Too.
Right. So if we're going to build a bank and get our client to be their own bank, wouldn't it be prudent to see and let the client see what banks are actually doing?
Correct.
Good idea, yeah.
Because we're trying to get them to really take on and have this project be their own and something that they want to do. Because if it's something just new and shiny and they don't really understand how it works and why they're doing it, the first new and shiny thing that comes along after that, they're going to jump at that too. We want this to stick.
So we want them to do what the banks do, not what the banks say.
Right. Right. We want them to do what they do, not do as they're told. So, okay. Somebody give me a bank.
Bank
Bank of America.
Bank of America. Great. Bank of America. So for anybody who does not have this, I am putting it in the chat, if I can find the chat. Okay, so now everybody should have this link. Bookmark it, you'll need it. Okay, so we put in the institution name into, and honestly, you can use any bank that they pick. So we're gonna search for this.
Oh, thank you.
Oh, really?
Uh,
Let's try this again. I try to be prepared and then it logs me out. Okay. There we go. Okay, so in general, we're looking for the one that has the lowest number. So we're going to take a look at the assets and liabilities report for any bank we're looking at. So we're going to check this to make sure that we're looking at the most recent one. And it looks like March is the most recent one. June has not been released yet. So, and we're going to generate report. Okay. So a couple of things I want to point out to people, just background information that is going to be useful to you in dealing with other clients. We're looking at all of these numbers as dollar figures in thousands. So basically what that means is any of these numbers, to get the full figure, we need to add 3 zeros to the end of it. So if I was to ask you, think outside of being an insurance professional, where do you think is a good place to have money? What is a safe bet?
what kind of, is it safe money or investing money?
Most people would say money market.
Yeah,
Money market, anything else?
Or they say a mutual fund. If you're coming from a client standpoint, that's what they're going to say.
Real estate?
Real estate is the other big one. Yeah, so money market, real estate. So if we're looking at a safe bet to grow money, most people are going to say real estate because real estate genuinely continues to grow. So if we're looking at March 31st, 2021, this is where Bank of America has all of their assets. First thing we're going to look at is their real estate. So that is bank premises and fixed assets and other real estate owned. So that is 19.165 plus 328. So that's basically 19.5 hundreds, thousands, millions, billions, $19.5 billion that they have in real estate, right? Sounds like a lot of money. Yeah.
Yes.
Okay. Is that where they have the majority of their assets?
No.
So we're going to come down to line 41, their life insurance assets. So 24.1 thousands, millions, billion dollars, $24.1 billion that Bank of America has in life insurance assets. So if the bank is telling us that that's where they have their assets in life insurance, shouldn't we have our money in the same place?
Yes.
If that's how the banks make money? Okay.
Mhm.
Let's take a look at this. Why do the banks own life insurance?
Good question.
Okay, well, you know what? Google knows everything. Oh, sorry. Let me admit people. I'm ignoring the queue. Let's take a look at Google. Google knows everything. Bank owned life insurance. Okay, so we're going to ignore all of the ads and actually take a look at a real source. Investopedia. That is probably where most of our clients are getting their investment information anyway. So let's take a look at this. What is bank-owned life insurance? Bank-owned life insurance, also known as BOLI, is a product where the bank is the policy beneficiary and usually the owner. Such insurance is used as a tax shelter for the financial institutions which leverage its tax-free savings provisions as funding mechanisms for employee benefits. This permanent life insurance policy is often purchased for high earners and or board members of a bank, which pays for the policy and benefits after the insured individual's death. Banks do not take out bank-owned life insurance for every employee working for them, but only for those key players whose death could cause the bank to lose money. Bank-owned life insurance is a type of life insurance created to benefit a bank, not the insured or their beneficiaries. Bank employees may be offered a traditional at-work life insurance plan to cover their loved ones if they die as part of a workplace benefits package. So that's a lot to unpack, right? So basically what it boils down to is that banks purchase life insurance on key employees, CEOs, bank presidents, other bank executives, that the bank would suffer financially if that person died, thus creating an insurable interest, right?
Yes.
Okay, great. So they're also using the growth inside those policies as a tax shelter to fund other projects such as employee benefits. So there's a lot here that we've just said that we as financial practitioners may understand that a client is not going to understand. So we are going to do this. We are going to first Google tax shelter. And key person. I'll just say what is a key person because that's gonna, what is a key person? Okay. Awesome. Was there anything else that we should Google because we're not going to understand?
What's
No?
the question again?
So we've Googled tax shelter and we've Googled what is a key person. So are there any other terms before we start to unpack those things that we should also Google?
I don't know.
Okay, great. So we'll start there. And if any other questions come up, again, jump in because I want you guys to really benefit from this discussion. So the bank is using bank-owned life insurance as a tax shelter. So what is a tax shelter? A tax shelter is a place legally to store assets so that, a tax shelter is a place to legally store assets so that current or future tax liabilities are minimized. A tax shelter is a tax minimization strategy and should not be confused with the illegal practice of tax evasion. So by using life insurance, the bank is using money that cannot be taxed to fund other projects. Interesting. Okay.
Also known as leveraging.
Also known as leveraging. So also we know that the bank is putting these policies on key people, right? The key players. So what is a key player?
Manager.
CEO, president,
Yep.
board members.
A key employee or keyman is a term used specifically for an important employee or executive who is core to the operation of the business, and his death, disability, or absence could prove to be disastrous for the company or organization. Okay, so I have just Googled all of these things in front of you and pulled up resources. Why?
Illustrate why they need to use a bank. Build a bank.
To give the mindset of what a bank, how a bank thinks.
But why have I Googled it in front of you instead of just having all of my tabs open and just drag them in?
To get
Because
them
they can research it themselves if they don't believe what you're saying based off of you researching right here in
Gold
front of them.
star. Yes, because I want to show my client that I'm not hiding anything. I am showing them precisely what it is. I am showing them what my sources are. I mean, Economic Times is a reasonable source. Investopedia is a reasonable source. You know, these aren't like fly-by-night things that we're looking at. We've literally just gone to Google definitions and pulled up this stuff. So they can pull it up. It is available. It's just that they didn't know about it. The number one reason or the number one question really that I ever get from clients is, why don't more people do this? Why have I never heard of this before? Because we're not educated in it. That's why. So really what we're trying to do is educate our clients such that they feel comfortable moving forward with this, that they are part of it, that that's something that they want. But right now, what we have been talking about is bank-owned life insurance, right? So if we scroll down to the bottom, where is it? It does say somewhere in, can I buy bank-owned life insurance? No, individuals cannot purchase bank-owned life insurance for themselves. It is only for banks and corporations who purchase it for specific employees, often executives. Okay. So if a client is going through this by themselves, they're going to say, well, I can't do this. I can't do it. It tells me right here that I can't own bank-owned life insurance. Okay, fine. Let's start thinking about our households as a corporation. Okay, so we've just proven that the bank can purchase life insurance on key people because they have an insurable interest in those key people, right? If something happened to those key people, the bank's bottom line would suffer. That creates an insurable interest, right?
Yeah.
Yeah. Okay, perfect. So how do we look at ourselves as a corporation? So anybody can jump in on this. I want you to think of your household as a corporation. Who are the key people?
Your spouse and
Husband and
children.
wife.
And your children.
Yourself and your spouse. Those are the key people. Those are the people that are contributing financially to the success of the corporation, the success of the household. So if one of those people was unable to contribute financially due to death, illness, injury, etc., you know, the financial success of the household would suffer. Therefore, we've just created insurable interest in our corporation. So as a family, and obviously as a family, you have insurable interest in yourself and your spouse, just because that's the way it's set up. So we just need to think of ourselves as a corporation and build our own bank accordingly. So that being said, we've now showed how or why banks own life insurance, because we can now pull money out of those profits in a way that is not subject to income tax. But what else is it subject to? Anybody know?
What, the insurance?
Yeah. So if you pulled money out of, so I'm going to pull up, let me just get down to the right page so I don't make you guys dizzy by scrolling. So this is an illustration that I ran for a client that I'm actually working with. So this client is about 2/3 of the income of the households.
Mhm.
She is 38 years old, and this is the illustration for her. If she were to access the cash value inside this life insurance policy at any point, is it subject to tax?
No.
No.
As long as the policy is in place, it is not subject to tax. Is it subject to anything else?
It's not subject to anything else, I don't think.
Is it? Can we just pull this out without anything? There's nothing attached to it.
There are some fees.
There's
So-
interest, actually.
You said
So yes, that's how it becomes non-taxable. So it's non-taxable because when we access this money, it is a loan. We are never actually touching the money in our cash value pile. The
Right.
insurance company is loaning us money at a exceedingly reasonable rate. So if we are earning 5.5% on this $314,000, and we are it's 4.5% simple interest every year, do we care?
No.
Why not?
Our money is continuing to grow while we're using it.
The money is continuing to grow while we use it. Yes. So,
It's gonna be deducted from the death benefit.
and we'll get to that in 1 second. That's a really good point. So 5.5% that we're earning minus 4.5% that it's costing us to use our money. So let's say from that $314,000, you need to, I don't know, fix the roof on your house just for kicks and giggles, and it costs you $14,000. On that $14,000, so we still have access to the $300,000 that's still there. On that $14,000 that we have already spent on the roof to fix it, we're still earning 1%. What other bank will do that?
None.
Exactly.
You're a bank.
Yeah. Only the bank you create yourself will do that. So no, we don't care that we are we're getting charged for 4.5% interest because we're earning 5.5% on money that we've already spent. So we're still earning that positive 1% arbitrage on money that we have spent doing other things. We took a vacation, we bought a new car, we we bought an investment property, whatever it is that we did. All of those things are still earning us money. And when we put the money back, we'll have access to it again, but it's still earning money. No other bank will do that. So why is the bank so willing? Why is the insurance company so willing to lend us money?
Because they're gonna make money,
How?
interest.
Okay.
Interest, and they get to use that money over and over again as when you start paying it back.
Okay.
What you do
So-
with the same bank.
This happens to be a Forester's illustration. So for those of you guys who have been to my trainings before, I want you to think critically about what this policy is. And for anybody who has not been to the trainings before, again, feel free to think critically about what this policy is and jump in. So what about this policy makes the insurance company exceedingly willing to lend this client money?
The loan is
Oh,
already guaranteed.
Their money is secured.
Okay, it is guaranteed, it is secured.
Mhm.
Anything else?
Is it because they don't report it to the IRS as money that is either as income?
No. Okay, so let me give you a hint. It's about the type of policy that it is. What type of policy is it? Death benefit, you're getting closer. Well, actually, that is the answer. We'll go with that. It's the death benefit. This is a whole life policy, guys. So what is a whole life policy?
Guarantee of, it's goes across your whole life.
Exactly.
Sure.
So let's say this person, somebody give me a year. Give me an age.
75.
75? Great. So age 75. This client, if they died at age 75, is going to have a $5 million death benefit. So we know that that this client is going to have that death benefit because it's a whole life policy. It's not something that can expire. So what does that do for the insurance company?
There's no risk for the insurance company
to
Lose
loan them money, right?
to loan the money.
Yeah, because they know that they will have to pay a death benefit to this client at some point. So if they loan this client money early on, it's a 0% risk for them
Yep.
because they will definitely get that loan back with interest. Because if they died at 75 and they had $1 million of loans out against the policy, so we've got 5 million and change minus $1 million of loan, that this client's beneficiary is going to get $4 million and change in death benefit, non-taxable. What other investment could an insurance company make that has zero risk?
Whole life.
Key person insurance. So it comes back full cycle. The insurance company is going to do key person insurance. The households are going to do key person insurance. Banks are going to do key person insurance, and it all boils down to the same thing. But to any other investment to grow money, has inherent risk to it. So by the client building their financial assets in a guaranteed, predictable way, this client told me that they want to retire in their 50s. So let's say 58, just this person, not including her spouse, at age 58 is going to have $1.3 million in guaranteed cash value.
Mhm.
Guaranteed cash value. So guaranteed cash value does not include any dividends that may or may not be paid. And just for the record, Foresters has paid a dividend every year for anecdotally 100 years, on paper for well over 60. At that point they stopped counting, but anecdotally they've paid a dividend every year without fail for over 100 years. So really we're much more likely to be in the $1.5 million range with just this client, ignoring the bank that they would also be putting on her spouse. So why wouldn't they want to do this?
Mhm.
Why, who would want to do it?
The-
The
Is
client?
there a reason that the client would not want to do this?
Most of the client I run across is they got caught up on the life insurance part, and they don't think through. And on top of that, the bank or wherever they turn to, oh, that's a life insurance, or like Dave Ramsey, oh, that's evil. So
Okay, great.
you know,
I'm so glad you brought up Dave Ramsey. So
Mm.
Dave Ramsey says that life insurance is evil. Why? That whole life is evil. Why?
Because the agent's making all the money, or the insurance company's making all the money.
But what does he say about the product?
Oh, I don't remember.
I don't know.
Whole life insurance is evil because you are only guaranteed to make 6% per year every year.
That's not bad.
Somebody want to tell me why making 6% guaranteed is evil?
no, that's not evil.
He's comparing it to the volatility of the stock market and putting it in the market.
Right.
Well,
When he wrote his book in 1991, 92, a monkey with a dartboard could make money in the stock market. And they actually did prove that. They did an experiment. They lined up a bunch of stocks and had a monkey throw darts, and whichever stock it landed on, they invested in, and the monkey made money in the stock market. You can't do that now.
Mhm.
So the reason I go through all of these things, and I didn't pull up the tabs prior to, I actually had you guys watch me Google everything, is for this exact reason. I never say anything. I let other people say it for me. You want to tell me that Dave Ramsey says that life insurance, that whole life is evil? Great. I will tell you precisely what he says about why whole life is evil and let them draw their own conclusion. So he says it's evil because you're only guaranteed to make 6%. If you were making 6% every year, would you be upset?
I think his argument was the dividend. They go like dividend, you know, that is your money, you know, because they pay back, and he has some argument about the
Return on-
charging an interest on your money, you know, so
Are we
why you
talking about
borrow your
the
money,
dividend or the loans?
both. He using
Okay, great.
attack
I can
on
address
both.
those separately. So the
Mm.
dividends, fabulous. If you're using a corporate strategy whole life company, it's not going to do this. I only use mutual companies to build a bank with because there are no stockholders that need to make money. The stockholders are the policy owners. So the dividends, all of the profits get divided up and added back to the cash value of the policy owners. So that is very, very important because if you're using a company that has shareholders, the shareholders always have to make a profit or they'll dump their shares. So the company has to make the shareholders happy. So just because there's a chance of a dividend doesn't mean you'll get it. In a mutual company, if there's a profit, you're getting a dividend. With a company like Foresters, Mutual Trust Life, these companies have paid a dividend every single year through COVID, through 9/11, through both Gulf Wars, through the Vietnam War, through the Cold War, World War I, World War II, the Great Depression, all of it. They've paid a dividend every single year. Where is the risk? Okay, so and let's take a look at some of those crashes. The .com bust, the housing crash, the Great Depression. These companies still paid a dividend on top of the contract rates every single year. Any investment account at that time was tanking. And these people were still making profits. Anybody who had, hold on, in Dave's opinion, the insurance company gives back a portion of an overcharge in dividends.
Yeah, he said overcharge.
Gives back a portion of an overcharge.
Yeah, basically that's return
Okay.
on premium.
Yeah, basically he said that the customer, the client pay, and then at the end of the year, they overcharge all these clients, so they return that money to them. So it's not, they're not making any money.
Okay.
I think Dave was confused between investment. This is a saving vehicle, and he compared investment.
No,
So
he's not confused. He doesn't care.
Yeah, he doesn't care. He just using, you know, just
He's
throw
not
it out there.
confused. He's not. So something I'd like all of you to really understand is that Dave Ramsey is not licensed in any state. Reason being that if he was licensed as a financial practitioner in any state, people could sue him.
Yeah, he violated a lot of.
Because of the inflammatory statements that he makes, he'd lose his licensure and people could sue him for giving bad advice. So, you know, that keep that in the back of your head. That's probably not going to be a great argument to sway a lot of clients, but you knowing that is a very powerful tool. So when Dave Ramsey says that it's an overcharge in dividends, okay, fine. So he says buy term, invest the rest, right?
Yes.
Yeah.
Okay, fine. So buy term, invest the rest. I'd like to take a look at what this client has put in over 10 years, okay? So our total input, let me make
Nobody
this a
does
little
that.
bit bigger because it's a bit of an eye chart. So this client in year 10 has put $569,000 into this policy. Yes? Everybody see
Mhm.
that?
Yeah,
Okay. Can somebody tell me what they have in guaranteed cash value also in year 10?
over 600.
Over $600,000, right? So, this person has what, 40 odd thousand? Sorry, was there a question? Okay, so this person has a 40 odd $1,000 arbitrage in guaranteed cash value. That does not include any potential dividends. So it's highly likely that it's going to be more in the realm of $654,000, which is almost $100,000 arbitrage. So that math, can somebody tell me what this $4 million death benefit has cost them?
Nothing.
Nothing. Okay,
Mhm.
fabulous. So, let's fast forward to age 68 when most people retire. So how much do they have in death benefit?
4.6 million,
6.
$4.6 million. Okay, how about when they get to age 93? How much do they have in death benefit?
over 5.3 million.
When does this policy expire?
And they
Never.
done.
It never expires, right?
Mhm.
They would have to reach age 121, at which point they would just be handed back all of the cash value inside of it, which matches the death benefit. So if I keep scrolling down, that's almost $5.4 million. Okay. So if you have a client that is arguing this point that cash value life insurance is expensive, run a 10-year, a 20-year, and a 30-year term for the same client
Hmm.
and find out what it's going to cost them. Because these people are going to tell you that when they are, once their kids are grown and gone, when they retire, they don't need life insurance anymore. But if they have a term, what is the cost?
No.
Actually, you know what? Give me a second. I will run it for you now. Let me log back in. Okay, so we're gonna do this. Illustrations. Level term. I think it's your term. Okay, so this client is in Massachusetts. We're going to say that it's a medical product. We're saying that they're 38 years old. By the way, I run all of my illustrations as standard. If somebody comes back better than standard, more is the better. They have more cash value. So we'll run this one also standard non-tobacco, death benefit and funding. How much premium do we want? Excuse me, how much death benefit do we want, guys?
$1 million.
$1 million? Great. Yep, okay. Premium mode, we'll call it annual because that's what we said. And we'll go for the 20-year term because that's what the other one has on it. So at a glance. Okay. So it's gonna cost $1,250 a year times 20 years, right? So $1,250 times 20 is $25,000. And that only gets us through age 57. So at age 58, when this person said that they want to retire, they no longer have any sort of life insurance, right?
Correct.
Mhm.
So if this person dies at 60, how much death benefit do they have?
0.
0.
And what did it cost?
25,000.
Versus our, where did I put it? Versus our other policy that has 5 times that. Let's say that this person also died, this client with this policy dies at 60, 4 times that at age 60. And it costs them how much?
Nothing.
Cost them nothing. So, and really, if they died at age 60 in either case, the other one has 0 death benefit. This one has almost 4 million. And at any point, they have access to the cash value. So what is the cost of whole life versus term?
$25,000 in this case.
In this case, it's 25,000. Actually, it's a lot more because we can leverage that cash value at any point. And no other investment account will continue to grow if we spend the money in it. They all drag down your value and grow at the lower value. This will grow as if it was never touched and gives you a positive arbitrage on money that you've already spent. So, yeah, feel free to use that, guys, when you're dealing with objections of that sort, because you shouldn't get caught in the, but Dave Ramsey says, great, use what Dave Ramsey says and repeat it back to the client in a way that it sounds as ridiculous as it is. Because are we not buying a term policy and investing the rest in a leverageable way? We have the death benefit and we have leverageable cash value. Does this not accomplish the same end in a way that it will never actually cost us anything?
Yes.
Does that make sense?
Yes.
Okay, so I know we've done a lot of reasons why we build the bank and how to build the bank and you know, things to show the client. Did anybody have any questions on what we've covered today?
I have a question.
Yep.
So I'm a little lost when you said it cost the client nothing for that Forrester's policy.
Okay.
Aren't they premium? I mean, I don't understand.
Sorry, say again.
So, I mean, okay, you said it costs them nothing to have this type of policy. But,
Right.
So the premium doesn't they have to pay their premium? Or I don't understand.
Yes, they do. So when I say that it costs them nothing, they have the ability to use the money that they've put into it. So the actual cost, the real cost is 0. So if you purchase something that comes to naught, there is a cost, right?
Yes.
But if you purchase something that creates a profit, is there a cost? There's an investment. There's an initial investment, but if it generates a profit, the cost is nullified.
That's correct.
Because we're leveraging this $600,000 of cash value against the investment of $570,000. So we actually at this point have $30,000 of profit. Therefore, the death benefit is a fringe benefit and has not actually cost us anything. Does that make sense?
Yeah, yes.
So it's kind of a semantic difference, but it's an important one. So I really want to make sure that you understand that difference so that you can point it out and explain it to any potential clients.
Yes, I do.
Yeah,
So
Kendra, I have a questions on the Where'd you get the, is Forester guaranteed 5.5 interest?
I want to say Foresters is actually guaranteed somewhere around 4% right now, but don't quote me on that.
It's
Um,
uh,
but their annual dividend, to the best of my knowledge, has never been less than a total of, including the guarantee, 5.5%.
I see. Okay, so that, plus dividend.
Yeah, so including the dividend, they're at about 5.5%.
Okay, and then
Minimum.
the, at this time, right? And then, they charge the loan rate is right now is 4.5.
I want to say it's 4.5. It may have changed recently.
Okay.
So, but that's about average.
Yeah, about the average, but here's the, remember you say the loan they charge is 4.5 simple interest.
Mhm.
The 5.5, plus is the compound interest.
Mhm.
So those are the two big different.
Yes.
So the 1% that we compare, say, oh, 5.5 minus 4.5 is 1%, is actually is
It's a lot. But when you're
Yeah.
dealing with a client,
the
and you
level of the
start going
client.
into the difference between simple and compound interest, I mean, unless you're dealing with an engineer, they're just going to glass over and you will have
Right.
completely lost them. So
Right.
it's easier to just do simple math. Like, you guys should definitely understand the compound difference. And if somebody needs me to go through the training on simple versus compound interest again, I can revisit that in the next few weeks. I know we did that, I think, in the spring. Yeah, so we can revisit that, but you guys should understand the difference. But in terms of dealing with a client, just go with the straight numbers. They can understand that conceptually, most people are gonna glass over when you start talking about exponential math.
Yeah, and then also, like, if they take the money out and they, for some people that do flipping or investing or whatever, that the 4.5 they divide by 12 months. So that will, how much is that a month?
So if it's
It's
$100,000,
about 0.375-ish percent a month. So if somebody do flipping, it's not 4.5 because they've done the project in 3 to 6 months. So it's like 2%, for that loan, and then they return the money back, and that they keep going and keep doing over and over again. So
right.
those are the things that if we talk to those people that they real estate investor or something.
Right. So if they started borrowing from the bank, they're going to get a 4%, 5%, 8% compound interest loan for a short period of time. And it's really going to eat into their profits. But I mean, it's $4,500 annually for a loan of $100,000.
And-
Versus whatever profit they can make on that by an investment property or flipping the house or what have you. So food for thought. But I think I saw Ray jump on, so I know he wanted to say something today. So I'm going to stop sharing. And if anybody has any questions, comments, other topics that they would like to see covered, I'm putting my email. I can financial.com in the chat. Feel free to reach out to me if you that would be the Forester's Advantage Plus 2 was the illustration that I ran. So if anybody has any other questions, please feel free to email me, and I am going to Sabrina, did you have a question? Your hand is up.
Yeah, I had a question about the software, that Life Plan 360.
Yep.
How do we get access to that?
That is actually a perfect segue into what Ray wanted to talk about today.
Oh, okay.
So Ray, I will hand it over to you.
Very good. Hey guys, it's good. Hey, Andrew, it's good to see you, man.
Hey, right.
Good to see you. I was going to reach out to you here a little bit later today, so you'll get a phone call later on today from me. But hey guys, I just wanted to say, man, hats off to Kendra, man. She just did an awesome job, man. She's really, I mean, I'm sitting here going, wow, this is really cool. This is, you know, and so great job, Kendra. Great job on that. I mean, you're doing a fantastic job. Guys, do you see how easy she's making it, you know, with the illustrations and all that stuff? Does it make sense to you guys? Can you see that? Type in, I get it. I don't want people to type. If you're enjoying what you're getting from Kendra and I see how easy she's making it seem like, type in that I get it. Type it in. Let me see you guys are good. Okay, awesome. So guys, so the more that you are, I want to hop on this training call real quick. I'll be very, very brief, I promise. You know, those of you guys that know me, I'm like a Baptist preacher. I got like 7 closings, okay? In closing. But the reason, you know, why this is so important and the reason why I want to hop on here and it was to kind of talk about what Kendra is doing and what she's sharing with you guys. This is literally life-changing. I mean, so many people out there do not know or understand the power of banking through insurance and everything that Kendra's laying out. You know, so this is a huge opportunity. So I applaud you guys for being on this call and really absorbing the information that Kendra's laying out for you guys on this call. And also, I will encourage you guys to start talking about this call to other people. Start talking about this call to other agents. This is a great way for you to recruit other agents, if you will. If you're looking at bringing on other agents into your business, this is a great way to do that too, because you can override off what your agents are doing. So that's another thing that you can kind of think about. But what I want to kind of talk about, and to answer Sabrina's question, Sabrina, to get access to the software, you want to go to lifeplan360.com, lifeplan360.com, and then you can get access to the software there. I think Kendra's going to get ready to type it in there. If I see her and I have been, I was right. Obviously, we spent too much time together, man, but we're like, you know, our brains are in sync. But go to lifeplan360.com and get the software. Now, real quick, guys, and I'm going to end here. The reason why I want to hop on this call here is to talk about the software. The software is something incredible. So look what Kendra is doing today, talking about the illustration, not just today, but on every training that she does. She's kind of laying out the illustration from Forrester's, right? But also she's coupling the Forrester's illustration along with the LP360 software. Now, the software makes a huge difference for you and for your clients that you're dealing with. And I talked about this before. So one of the things that the software does that's really important is that as an agent, I know for someone like myself, I need the software because the software kind of guides me and it directs me on what it is I need to do, what I need to say, where do I need to input what information and all that stuff. So it kind of guides me. And so then also by guiding me, it gives me that confidence, right? It gives me that confidence that I know what I'm talking about. Because one of the biggest fears a lot of us have as agents, especially doing the banking through insurance on their first time, isn't it kind of scary on your first client or first few clients? First few clients, that kind of scary, right? I mean, if it's scary, so like, oh my God, I don't know what to say. Oh my God, I'm not sure. You know, how to say it or what to say or where to go, what to do. That's what the software is for. So the software is there to guide you. It not only guides you, but it gives you the confidence, number one. The other thing about the software that's so freaking important is this, is that when you are sitting with your client and the client sees that you have software technology at your fingertips and they see the software, Does the software instantly, does that give you credibility? Yes or no?
Mm-hmm.
Type it in. Does the software give you credibility? Yes or no?
Yes.
Okay, so you know, so that's why it's the beauty is to have the software. So when you're sitting side by side with somebody, you're a client at a Starbucks, or you're doing a Zoom call like this one here, and you're with your client, and you're able to pull up a software, the input all the information to show them everything so they can see everything, and they're able to build their own plan using the software. That's going to make a world of difference, not just for yourself, but also for the client. Imagine trying to show all this. Imagine trying to show the illustration and explain everything without the software. How would that look if you didn't have the software? You'd be jotting on paper, be all scribbling, you'd be writing stuff down on paper, drawing charts and circles and buckets and doing all kinds of stuff. So this is why it's important for you guys to get on the software. If you don't have the software, go to lifeplan360.com to get the software. If you have the software, start utilizing the software more. Start practicing it on yourself. Write out fake cases, write out dummy cases. That's how you're going to learn. And the best way to learn, actually, is to write a case on yourself. You know, if you don't have a banking policy, it's a pretty good idea to get one, because you're talking to other people and encouraging other people to get banking policies on themselves, but yet you don't have one, right? You don't go get all big and get all fancy. You don't need to spend $20,000 or $30,000. Just get a small one. Get one that you can afford. But at least now you have your own banking policy, and then you can talk from strength, you can talk from confidence, and you can talk from know-how. But anyway, so I just want to get on the call real quick, guys, and let you know the power of the software. Kendra's doing a phenomenal job, great job on explaining everything. But understand the power of the software. It does two things for you. It gives you the confidence. It gives you the confidence. It gives you, tell you what to do, what to say, how to say it. Then also too, number two, it gives you credibility with your client. It gives you instant credibility that you're not some, you know, mom and pop shop organization. You're not some Mickey Mouse organization kind of drawing stuff out on a whiteboard or on a legal sheet. You actually have software technology, and that makes you look more like a professional. This is the value of software. This is why we have it. So take advantage of it, guys. And I appreciate all you guys. Kendra, phenomenal job. Marcus, good to see you. Andrew, I'll be calling you later. John Pruitt, man, love you, brother. Peter Jackson, haven't seen you in a while, Peter Jackson. Miss your hair. But anyway, man, it's good to see some of you guys on here. Love you guys. And we'll see you guys on the next call. And also, too, I'm going to start putting the recordings of these calls onto our ICANN Facebook page. So you can go back and review some of these trainings on our Facebook page. So check out ICANN Financial on Facebook. And then I'll start putting some of these recordings up there as well. All right, guys, man. Kendra, thank you so much for letting me barge in on your training like this, man. Coming here, like, come knock the door down. But I heard Andrew Long was here, so I had to go see him personally, man. So, no, just joking. But anyway, guys, appreciate you guys, and I'll see you guys next time. Thank you, Kendra.
Okay. Well,
See you later.
I think
Take
that's
care,
everything. Reach out if you have any questions, and we will see you next Thursday.
All right. Thank you, Kendra.
Have
Have
a
a
great
good one.
weekend, guys.
Take care.
Bye.